All right, let's hear it out then from Neelkanth Mishra talking about the robust macros and investment cycle, what his view is when it comes to the sustaining growth while overcoming several challenges and how earnings are in good stead. Let's hear it out from the Chief Economist of Axis Bank, Neelkanth Mishra.
As we think about the world in the next 5 years, I think the pace at which capital formation is triggered by the opportunity for exports in goods and services is actually going to be a lot lower than it was in the 2003 to 8 period. There are ways to accelerate this process. So if, for example, we were able to improve, ease of doing business, significantly simplify our taxation structures for corporates, especially foreign firms, and we equally importantly work on urban infrastructure, because that is a space where significant amount of capital formation needs to happen. There is a big gap between demand and supply. And if we are able to get urban infrastructure investment to accelerate in the next 5 years, then I think potentially we can do a 7.5-8% growth, because that's an area where we need to invest. And if we are able to, it will also help sustain the real estate cycle for much longer. So there are ways and ways of getting about it, but I do see significant challenges in going well above 7%.
Fair point. Neelkanth, what does it, where does it really take us in terms of market cycle then? When we are already at a peak kind of a performance rate on growth, and higher growth from here on comes with its own challenges and to-do list. Market on the one hand are actually at a premium to other emerging markets, premium to many other globally well-traded markets. How much does it leave the PE expansion part of the market scope on that sense? Or unless and until the entire composition of the market does see growth acceleration on earnings, we are susceptible to some corrective phase.
The real GDP of FY25 has been revised up by nearly 3% points over the last 1 year, which is a substantial revision. And what it does is it bumps up the demand for many goods, services, assumed demand for goods and services. And that upgrade drives a very positive momentum on PE multiples. So I think the assumption and expectation is, which is why I think the PE multiples have actually held up despite the high cost of capital, the high risk-free rates in the world. If GDP growth acceleration cannot sustain, meaning that the upgrades to GDP are not really going to happen even further, meaning that we are already at 7.5. I think most people are now assuming that. Now, if we do not have the steam, given all the global headwinds and all the concerns that exist, of going above and beyond the 7.5 to say 8% plus, then perhaps this expansion in PE multiples may not sustain, and therefore we could see a period of a bit of time correction. On the technical side, or rather, let's say the flows side, generally, flows tend to be turbulent, and therefore they don't sustainably raise PE multiples. But what we are seeing, and what we have been seeing in the last 3-4 years, is a very steady stream of inflows, and which are still rising. So when I started flagging these so-called unintended flows several years back, I used to talk about $25 billion a year, $25 billion a year. Now, if you just do the maths, these numbers are like $40 billion a year. So there is a significant increase in this steady flow of funds, unintended capital flowing into equity markets. And this is a very powerful driver of PE multiples. So this is likely to keep the multiples elevated. Remember that deep corrections become very difficult when mutual funds at any point of time are sitting on 1.25 trillion rupees, 1 lakh crores of cash. So whenever there is like a 4-5% drop from the peak, there is a spate of buying. That drop in volatility of the asset class, meaning because the equities as an asset class is not seeing sharp drawdowns, actually in the short term makes it safer to invest in, and that attracts more funds. So that's the cycle we are in. I think it would be wrong to just look at PE multiples and say they're too high, which they are, and say that that's why they're going to correct. But I do think that the first factor, which was a steady upgrade to trend growth assumptions, that may start to slow down now. And therefore, my view that we should see some time correction in the markets going forward remains intact.
Excellent explanation. Neelkanth, within the market, if one were to divide it in market cap terms, just for the better understanding, top 100 companies, which includes large and mega caps, and then the rest, which is broader market, and they are seeing a massive healthy addition on new IPOs, so categories opening up, etc. Which part do you see valuation versus earnings growth argument not in favor of?
So I still think that if it is a flows-driven argument, then it's very important to plot how flows are happening as a percentage of relevant market cap. And there I see that the flows to small cap and mid cap funds, and the measure we use is 12 months of flows, like the last 12 months of rolling 12-month flows, as a percentage of the market capitalization of that sector or that segment. So those flows for small and mid caps had actually reached 1%, 0.8 to 1.2%. That generally is the level at which we have seen historically those levels sort of falling off from, that is peaking at. So we have seen that now there is a bit of a correction that is starting to happen. Large caps, on the other hand, because of this preference, because incrementally savings were being directed towards small and mid caps, the flows argument on large caps is that things may actually pick up from here. And some of the things that we have seen recently, like the rebound in bank stocks, because the concerns around NIMs, etc., are kind of now fading. I mean, incrementally, not a lot of more pressure coming on NIMs. We have seen telecom tariff hikes. So in general, the large caps, to me, seem to be better supported than the mid and small caps.
Neelkanth, we'll talk about certain sectors in a moment, but right now the big focus for the market is budget. We are running up to the budget in almost 15-20 days. And the expectations after this government formation has happened is that the government may actually try to do a kind of a balancing act between prudent fiscal policies as well as kind of putting some cushion in the rural market. The rural economy, tier 2, tier 3 got badly hit. They need to be addressed. And this time they do have ammunition in terms of the big dividend from the RBI and the numbers, macro numbers which have come in. So how do you think it will be managed this time around in your view?
From the perspective of the government, there is no reason why the clear benefits we are seeing from the fiscal consolidation path should be frittered away or be given away. And therefore, my expectation is that the fiscal deficit number is likely to stay unchanged, or if at all, it should actually go down because of the RBI dividend that you mentioned. So it's a very, a technical kind of transfer. It doesn't really change borrowing numbers, etc., that much, but still the 5.1 to 4. In the demand supply for bonds that much, but the headline number could actually, there's scope for it to be brought down. It is also possible that the center increases the capex, the interest-free loans that the center provides to states for capex to be actually increased, given that there is more space. What the budget may also do is make meaningful announcements on the path towards the Viksit Bharat 2047, that if we have to think about developed India in 2047, what are the things that we need to do, and some announcements and schemes around that. Those would be my expectations from the budget. If there is more of fiscal transfers, I think that is very likely, or that is most likely to happen at the state level and not at the central level. You see what has happened, for example, in Maharashtra in the announcements in the new budget last week. And so if a state really wants to go down that path within the constraints imposed by the center, as you know, the center imposes under Article 293 of the Constitution effectively a 3% of GSDP limit on borrowing. So if the state wants to, within that limit, spend in a certain way, I think they have complete flexibility, and that is what Maharashtra is utilizing. But at the central level, I don't really see a change or don't really expect a change in the fiscal path.
Neelkanth, are you witnessing some green shoots, as even the RBI governor did mention in his speech after the policy, in the rural side? And will that green shoot actually translate or start reflecting in the corporates which are representing the rural or tier 3, tier 4 India in the next couple of months?
I think that the fact that GDP growth is 7%, I think it should flow down to everyone. But my expectation is that at this stage of development in the economy, there is a natural increase in inequality that emerges, partly because there is so much of labor transitioning from informal sector and from agriculture into formal sector and industry, and therefore the pricing power for labor is a lot weaker. Cyclically also, while we have done very well, and as we've been discussing, our trend growth rates are far superior to what people had feared, and RBI is also corroborating that. The fact is that we are still about 7-9% below where we would have been if the pandemic had not happened, and which means that there is almost a year of extra workers in the economy, and that means that the pricing power for labor. So it's not just those 1.5 crore people who entered the workforce and have not been able to find work. It is also the impact they have on the earnings power of others, because the demand supply gets distorted. And because of these factors, I expect that the consumption by the lower income households will grow slower than the average GDP. So the GDP on average. So that's how I would look at it. That GDP grows. I think it helps everyone. It helps some more than others because capital share of income will go up, and therefore the top line growth for FMCG companies, which was say about 6.5% in the last 2 quarters, I don't expect to move meaningfully. The fact that price growth has slowed and therefore volume growth is picking up is great, but the mix, in fact, the space for it to grow more than high single digits looks very different.
Excellent point, Neelkanth. It's not urban versus rural anymore. It is lower income versus higher income, and urban poverty actually is also something we don't talk much about, but it is prevalent. Neelkanth, before we let you go, just a quick answer on where are you most comfortable on in terms of sectors, and where earnings growth versus valuation argument is very comfortable, and which ones are you least preferring right now because the argument has run out on its course?
So those preferences remain the same. So financials and utilities are the 2 sectors where we find that versus their own trading history in the last 10 years, the PE multiples compared and the standard deviation. So if you adjust for that, the 2 cheapest sectors are financials and utilities, and we find that sectors like IT are in that sense overpriced on the same measure. There's a great set of companies, but as stocks, and especially given what we think is likely to happen to their earnings assumptions going forward, we think those seem to be the most overpriced.
Right. Okay, that's an interesting slice of conversation with Neelkanth Mishra talking about the economy right now. But let's.
If you like this video, then like, share and subscribe to ET Now.